Welcome to Chartered Accountants Academy video lectures. My name is Philip Chambati, and today we're going to cover the topic double taxation reliefs. Our objective is to understand when they apply and how to apply them and what rules are followed around double taxation. So the double taxation problem is two entities or two jurisdictions will be able to tax the same amount. And this will be caused usually maybe because of the difference in the type of taxation. Either one entity is one jurisdiction is source-based and the other is residency-based. So both will be able to claim the amount on that income, or it will be because of deeming provisions which deem certain incomes to be from a source. Within Zimbabwe, even though both jurisdictions could be source-based, but one jurisdiction has a deeming provision that will deem a particular income to be from that source. Therefore, now you've got two jurisdictions which can tax the same amount. Hence, we have the double taxation problem. So we'll need to look at the available reliefs that our Act gives us as far as double taxation is concerned, and also which agreements should we be looking at as far as our syllabus is concerned. So what are the available reliefs as far as double taxes are concerned? So in our Act, each agreement that we have, so the amount of relief will depend on the agreement that you're looking at, because each agreement will state which incomes are subject to that agreement, how much relief actually that is applicable to that agreement. So you'll need to look at the particular agreement and not worry too much about what the Act says, but be specific on the agreement and the type of incomes. Not all incomes, just because you have a double tax agreement with a certain country, does not mean all incomes are subject to that agreement. Each agreement will state the particular type of incomes that are subject to that agreement. And more than usually, it will be your withholding, the incomes that are subject to withholding tax, like your dividend income, interest income, royalties, and fees. So, but it's not always the case. Sometimes even your business income is liable to such agreements. So you can look at maybe the agreement we have with the UK, which is very different to the agreement we have with South Africa, whereas the UK one mainly covers technical fees, interest and dividend and royalties, which the African one then goes further and even covers your business income. Now, as far as reliefs are concerned, Section 92 is the one that limits the relief. It doesn't necessarily give you how much is relieved, it just limits the relief to the amount that does not exceed the given formula. And this formula, in short, literally just tells you that it will be the lesser of the ZIM tax that you'll be taxed on that amount, or the foreign tax that you've paid. So in other words, Section 92 limits the amount of relief granted based on a formula, and this formula in its basic entities reduces the maximum amount or that you can actually get as relief to the lesser of the ZIM tax or the foreign tax paid. And Section 93 now, this one gives relief to incomes where there actually isn't an agreement between the two countries. And again, please note to read it carefully. Section 93 only applies to the Commissioner's discretion, and you would have had to apply for this relief for starters, and the Commissioner would have to see that the relief is necessary. It is not always granted. It is based on the Commissioner's discretion, and the relief where there are no agreements existing will be similar to the relief given in Section 92, which will not exceed the lesser of the ZIM tax or the foreign tax paid. So now let's go into an actual example so that you can see how Section 92 works. So let's take, for instance, Mr. X, who earns the following. He earns interest from POS B in Zimbabwe of 21,000. He also earns interest from a company that maybe gave a loan of 50,000. He also earns foreign interest from Switzerland, a gross amount of 30,000. And within Switzerland then withholds 12,000. So he has a net there of 18,000 from Switzerland. As far as Ireland is concerned, he also earns foreign interest from Ireland a gross amount of 30,000, and we also Ireland withholds say 9,000. So in that case, our gross amount there will be 21,000 from Ireland. Then we also earn certain foreign dividends. From Switzerland, which will be a gross amount of 15,000 and will be withheld 5,250. Then from Ireland, we also earn a gross amount of 12,000, and the amount withheld from Ireland will be 1,800. So now I want to look at the taxable income for Mr. X. How do we go about this? So first and foremost, obviously, let us include all items that are needed to be included for taxable income. Please go back to your gross income principles to understand which amounts are included first. So for your taxable income, it'll come up to 110,000. This will be the 60,000, the gross interest earned from Ireland and Switzerland, which is 60,000, because these will be deemed to be earned from a source within Zimbabwe. As far as your POSB interest is concerned, this amount is exempt because POSB is an exempt entity, and in the third schedule, this interest earned from POSB is exempt. So that will not be included. The 50,000 obviously earned from the other company within Zimbabwe, that will be included in your gross income, and this comes up to your 110,000. So applying the normal tax rate to this 110,000 gives us a tax liability of 28,325. Now we need to relieve ourselves from these based on our DTRs. Now, if we're to look at the amount of tax we need to pay without foreign interest, the only amount we're earning is 50,000, because that's the amount we earn within Zimbabwe from a source within Zimbabwe, and is taxed. If we tax it at the 25.75, the amount of tax we pay is 12,875. Remember, dividends are, yes, they are taxable, but they're taxed at a special rate. They're not taxed at the same rate, it's 25.75, and so I'm not including them at this point in time. Now let us look at the reliefs that we can get as far as first interest is concerned. So using section 92, assuming that Switzerland and Ireland we have double tax reliefs with them, even if we didn't and we applied, we could actually apply section 93 to this. The calculation is still the same whether we're using section 92 or section 93. So how do we go about this? So as far as interest is concerned, for Switzerland, we will take the lesser of, as the formula says, the 30,000 we're paying, the 30,000 we receive from the foreign entity, multiplied by the tax that we would have paid had we not included any of the foreign interest, which is 12,875, divided obviously by all the foreign income we are looking at, which is 60,000. So the amount that we can deduct as far as double tax relief is concerned, our maximum amount that we can actually deduct would be $6,437.50. So you can either deduct that maximum amount or 12,000. Obviously, the lower of the two is your 6,437. For Ireland, it will be the same formula. Obviously, your 30,000, because it's the same amount we're receiving from Ireland, multiplied by your 12,875, divided obviously by your 60,000. The lesser of 6,437.50 and the tax that we paid in Ireland, which is 9,000. Obviously, the lesser of the two is your 6,437. So the total relief as far as interest is concerned should be 12,875. Now for your dividends, the amount that we actually get relieved will be obviously the lesser of the tax we paid in Switzerland, which is 5,250, or the tax that we would pay had we received that amount in Zimbabwe, which is 20% of your 15,000. So the lower of the two is your 3,000. That's the maximum relief you can actually get. For dividends in Ireland, it will be the amount you pay in Ireland, which is 1,800, or 20% of our 12,000, which is 2,400. So your maximum relief there as far as Ireland is concerned will be your 1,800 and not your 2,400. So how do you now work out the tax payable in total? So what is the tax liability right now? It's 28,225. From that, we less the double tax relief as far as interest is concerned, which is a total of 12,875, giving us now our tax liable at this stage will now be 15,450. Next, obviously, to work out tax payable as far as dividends is concerned, had we been paying dividends in Zimbabwe, we should have been paying your 27,000, which is your 15 plus your 12, multiplied by a 20% tax on dividends, which will give us 5,400. Less, of course, your relief, which we worked out here to be 3,000, which is the law of the two, plus 1,800, which will give us your total relief as far as dividends is concerned, 4,800. So we still, in this case, as far as dividends is concerned, we still have a $600 amount, which is still payable. Because the amount of tax we're supposed to pay in Zimbabwe is 5,400, we will be relieved to 4,800, meaning we still have a $600 payable. So total tax payable, therefore, would be your 600, right, plus your 15,450, which will give us a total of 16,050. That will be your total tax payable as far as Mr. X is concerned. I hope you understood how we look at our tax relief. It is the lesser of the formula amount or the tax paid in the foreign entity. That will be the relief allowable. If you look at the interest, there was no problem there. The formula gave us the maximum. But when you look at your dividends, especially with Ireland, although the formula gives us 2,400 for Ireland, the amount that will be relieved will be the tax paid in Ireland. So I thank you for joining me. I hope you understood. Please work through the example again and come to our lecture with as many questions as possible so that we can help each other learn.